Step into the fascinating realm of industrial metals, where steel prices fluctuate and market indicators are the pulse of an ever-evolving industry. Welcome to Cup of Joe, the metal podcast paying homage to our founder, Joseph T. Ryerson. Settle in, savor a cup of Joe, and let the conversation begin.
Hello, everybody, and welcome to December's Cup of Joe. We're a little bit tardy this month. We apologize. Another week you had to wait for us, but here we are. I'm Mike Carrazzo, and joined as always by Nick Webb, our Director of Risk Management, Commodities Hedging, and happy holidays to you, Mr. Webb.
Happy holidays, Mike. We got, 13 days till Christmas and about the same for Hanukkah. We're right in the thick of it.
Yeah, it's going by quick, really quick. It feels like it was just Thanksgiving, actually.
I think we actually have literally one less week between Thanksgiving and Christmas this year. So it kind of tightens the belt on getting that holiday shopping in. I need to get to work here soon.
Have you not started?
Barely.
Yeah.
How about yourself?
Well, I think we're near the end. When I say
Okay.
we, I mean my wife. She does everything for the kids, and it's all Amazon. There's Amazon stuff showing up every day. So I think we're ahead of it. So
to be in the packaging business these days.
Yeah, exactly.
Crazy.
Yeah, and I love your tree. Very festive in the background.
Oh yeah, thank you very much. We just got the tree skirt put under it just a couple days ago.
Does the dog? Is it real or fake?
This one's real. We got it at Home Depot though, here in the city.
Yeah, and so we have a real one too, and I figured the dog would go after it this year and start drinking the water, but none of that has happened.
No.
I know you got a dog roaming around there.
Yeah, Blue's she's been great with it. I think she's actually kind of scared of that corner of the room because that leads out to the balcony. I think she's scared of the balcony, so she knows to stay away from it.
It's funny, my dog always brings in branches and I'm throwing them out. And when I bragged in this tree, he's like, "Really, dude? You get to bring in a tree?
I don't
You
know
throw out my branches?"
I don't know if you can see it down there, but literally the only packages we have under there are about 6 or 7 dog toys for Blue.
Beautiful. Yeah.
So that's the only thing I've really done thus far.
Yeah, there you go. That's good.
Appreciate that.
Well, everybody, thanks. Like I said, we're about a week late this month, but we got a good one for you. So Nick and I earlier this week, we started chatting about the year, and we said, wow, this is going by pretty quickly. So we decided, let's go back to probably February. We didn't have one in January, our February, and go back to maybe what things Nick said was going to happen and see how those things actually did play out. I first should mention that, so now here we're at the end of the year, we're going to roll over into 2025. There'll be no Cup of Joe in January, sorry, no live one, but we have you covered. I think we've been promoting the last few, been working on this series called Made in Mexico. Nick and I have been talking to some folks that are part of the supply chain out there. One is a customs broker, another a cluster for the home appliance industry. We're working to complete something on the fabrication side, and we'll publish those throughout January, so you'll have your Cup of Joe fix. And then February, we're going to come back really strong for an hour and a half live episode, and it's going to be Nick joined by our supply chain directors. Nick, do you want to give any kind of teaser about what might look like?
Yeah, I mean, so while today is going to be a bit of a year in review, while also taking into context, current market conditions and a little bit of a forecasting into the beginning parts of next year, what we're going to do in the beginning of February is we're going to give a much deeper dive into the landscape. We'll then know, the administration will be in power, and by that I mean the Trump administration. We'll know a little bit more about what their plans are in terms of policy. And we're going to do a deep dive into what all of these things mean for, the manufacturing and metals markets for 2025.
It'll be fun. Yeah, those are really good. Yeah, we'll have our supply chain directors on. That's always a good time, getting everybody's perspective. So if you're kicking off, you want to plan 2025, take January off and join us in February and start planning. It's going to be 2:30 to 4 Central. Of course, we'll send out information prior.
Excellent. Let's go ahead and get into it. So as we always have to do, safe harbor provision. These are the opinions of Nick Webb, Mike Carrazzo. Do your own research. This is not investment advice. Some of these look backs and predictions that mainly I had made back in January, February of 2024. I want to make it very clear. I did not cherry pick these. I didn't do this on my own. These were sent to me by Mike. He went back and perused our old podcasts and came up with a list of things that he wanted to wanted to blast in my face and see how we did on these predictions. So we're going to dive into those. I've actually got a couple more in addition to that Mike is not aware of.
Ooh, all right.
A little surprise for you, but
Love it.
yeah, let's go ahead and get it. So
Yeah,
first prediction. Yeah, go ahead.
Yeah. So like you said, right? We went back and like I said, take your victory lap, because I think a lot of these things you said are well on. We got 5 to highlight here, and we try to grab one for each of the metals, a little bit of a macro as well. The first one is aluminum, as you see up here, for those of you on the video watching on the screen. So in 2024, aluminum prices are likely to experience upward pressure as unprofitable smelters curtail production, but then the market is expected to remain overall balanced with only slight surpluses. So how did that turn out, Mr. Webb?
Yeah, so I'm going to provide a little bit of visual context while I talk about this, but one of the things we talked about for a number of months throughout this year and probably even into 2023 was anytime LME aluminum prices tended to get around that 95 cent to $1 per pound range, it seemed like it would find support. And as fundamental research analysts would write, usually in that range, that was where you started to dig into the cost of producing or smelting aluminum ingot. So the idea there is you end up getting this floor, because if prices keep going lower and lower and lower, more and more smelters become unprofitable. So that acted as a floor. It had been doing so for much of 2022, 2023. And so the prediction was basically, we think that support is going to hold, and not only hold, if more smelters do curtail production, could that actually provide an uplift to prices? And I'm just going from January 1st through current pricing. And you can see the price of aluminum has gone from about right around $1.05, and maybe even slightly lower than that, all the way up to $1.18. And maybe the reasons why are slightly different than what I had predicted. And I would say they probably are, because I did not expect the price of bauxite and alumina to skyrocket the way they did. So what that means is, there's a raw ingredient called alumina that goes into the production of making aluminum. And there were a number of regions around the world, Australia, Guinea, a few other nations who are having supply chain issues in getting that raw material. And the price of alumina jumped over the course of this year by about 100%. So what does that do? That further increases the cost at which you can profitably make aluminum. So that's provided a bit of that tailwind. But we have also seen some discussions coming out of China in recent weeks where they're discussing further curtailing aluminum production, just because that raw material move higher has really created a pinch for the smelters. So I expect that this support is going to continue in the coming months, but you can see it's very much so throughout the course of this year. While it did have some choppiness to it, the price of aluminum shown over on the left-hand side did have a pretty decent tailwind behind it. And then further on the right-hand side, we've got Midwest premiums, which they were pretty flat for most of the year, but just in the last couple of weeks, since we now know who the president's going to be starting in January, he's obviously a big tariff person. And one of the risks out there is that Canadian aluminum ingot, which they export a very large quantity of aluminum into the United States, there's a risk that those aluminum ingots could get tariffed. And if that is to happen, we could see Midwest premiums jump by a pretty substantial amount. The math behind that is effectively 25% times the price of LME aluminum, which is right around $1.18. That would add on roughly 25 to 30 cents to the Midwest premium, which if you're doing the quick math over on the right-hand side of this chart, that's more than doubling the Midwest premium. Now, you can see that the market hasn't yet knee-jerked all the way higher to 45 to 50 cents, but it's certainly moved a couple cents higher. So what does that say? To me, that kind of says the market's pricing in a relatively low percentage likelihood that that's going to happen. But we're going to learn a whole lot more in the next 30 to 45 days around his seriousness in approaching Canadian steel and aluminum tariffs. So more to come on that story. Unfortunately, it's a little bit one of those things where it can be the difference between a headline causing it to jerk 25 to 30 cents higher, or it just doesn't happen and premiums stay down around these levels. It was interesting. I was on a call with a big customer of ours just a little bit ago, and he was indicating that their executive team is actually viewing that risk of tariffs as being much higher. I personally am of the opinion that it's unlikely that those aluminum imports are going to get tariffed, but yeah, they had a slightly different take. So, it's really going to be a bit of a coin flip on Midwest premiums.
You have that spike here in like end of March, early April. Was that around the time frame of the port in Baltimore?
I
Incident?
believe that was right. Yeah. It
And
seems like it was just yesterday, but yeah, it has been a number of months. There was a risk that because there was such large volumes going in and out of Baltimore that could have had an impact there. But yeah, that is, I believe that knee-jerk hire right there.
yeah, and I was talking to Jeff Notice, our supply chain director in aluminum the other day, and he was mentioning what you said about Canada, right? I didn't realize how much of that export comes out of Canada, and that would add
Yeah, I
upwards of
want to say
20-some cents.
it's like 80-85%. It's a
Yeah.
very large number. So
Yeah.
yeah, that's that's where you kind of have to weigh the decision of, do you want to be strong on tariffs or are you okay with and are you okay with the resulting inflation that it would have on canning companies and automotive companies? It's gonna there are definitely some big pros and cons to that type of approach.
Yeah. But as you look back on this one, what would you say? Winner? Did you accurately predict this one?
I call it a pretty decent winner. Now maybe for different reasons than I would have thought, or maybe there were additional reasons than what I simplified. But the raw ingredient of alumina, the fact that price went up by 100% certainly provided a tailwind. But yeah, I'm going to take the victory on this one.
All right, 1 for 1. Good job. Batting 1,000. All right. Nickel, talking a lot about that this year. Indonesia's rapid expansion of nickel production. Now, you said projected to account for 75% of the global output by the late 2020s. Now, that's going to continue to create oversupply. I already tell you that this is a yes. Suppressing prices until significant production cuts occur.
Yeah, so we beat this one to a pulp throughout the course of this year. It was the entire theme of 2024, which was Indonesia continuing to ramp up supplies. And you can see over here on the right chart, that is the supplies of nickel, class 1 nickel going into the London Metal Exchange warehouse system. And you can see it's nearly tripled over the course of this 12 months. So that side of the prediction, very much so spot on. What I was surprised about was when I just put the starting point of the price chart over here on the left-hand side as January 1st of 2024, even though the price has come down over the course of 5 years, on a 12-month basis, it actually hasn't come off all that much when you just look at the starting point and the end point. Now, we've seen a lot of volatility in the middle ground. And so if you're benchmarking against May, we've come off drastically. If you're comparing against January to now, it's actually not come off all that much. So I'm going to call this a partial victory because the price really hasn't collapsed from the starting point to the end point. So I'm going to call this partial victory. And what's interesting, we've talked about in the last couple of months, this $7 per pound mark on nickel really seems as though it's been acting as an area where whether it's for cost support reasons or it's a technical reason, $7 per pound has really been an area that's held up decently well, even in the face of ramping supplies of nickel. So I think that's going to be an interesting one that we want to keep an eye on, because if that $7 area keeps holding and the more consistent it holds, we could see a little bit of upside in nickel prices as we roll into 2025, particularly if Indonesia takes its foot off the brakes a little bit on production. And there have been some rumors that they're considering that in the last couple of weeks.
Look at those inventories.
It's crazy, isn't it?
Yeah, I mean that's insane. I mean, if you look at from January, what are you at there now? That's 1.64 million tons?
Yeah, so it actually went from about 60,000 tons up to close to, I think we're currently sitting at like 164. Yeah, 164,000 tons.
So is that going to, I guess, looking into the year ahead, I mean, not to project or not, is there anticipated that those inventories are going to come down, or is that further exasperated, right, by the fact that perhaps like EVs might not be as strong with the new administration? I don't know. What are your thoughts?
Yeah, I mean, most bank analysts and commodity analysts, they're still forecasting that the market's going to have surpluses, but there is an expectation that at some point Indonesia is going to say, okay, we've bankrupted enough other competitors, we've driven the price down low enough that others don't want to play in this market anymore. We've done enough, and then they start to actually slow some of their production capacity. At that point, I think you can start to see some price recovery. You would probably start to see LME nickel inventories level off at the very least. I think before we see inventories coming down, I think the first thing we need to see is just a leveling off of those inventories. And so I think we probably, if I'm going to make a prediction, I don't want to get too far ahead of myself for February, but if I'm going to make a prediction, I would pretty confidently say that the rate of increases in 2025 for inventory levels is going to taper off a little bit. That's one of my predictions.
Okay, so we're saying this one's a half.
Yeah, I'd say partial victory.
Partial victory at 1.5,
yeah.
1.5.
Sure, let's do it. Yeah.
Okay. All right. Let's go steel. And again, these aren't softballs. I mean, these are where they're like, this is definitely going to happen, right? So we had a sharp rise in U.S. steel prices due to constrained production and higher raw material costs. Check. Prices are predicted to experience significant deflation in 2024 as supply catches up with demand.
So this is a pretty easy one. Almost for the entire course of the year, we saw nothing but month over month price declines.
Yeah.
Now for the last couple, we have started to see some stabilization. Certainly haven't seen things rip higher just yet, but you can see it very easily on the left-hand chart. We went from starting the year out with hot roll prices up above $1,000 a ton. That means that pretty much every other sheet price is above 1,000, tube prices, plate prices, they were all very, very elevated beginning of the year. And between a combination of just things coming back down to earth, clearer heads prevailing, new supply coming online, all of those factors really helped to contribute to decreased prices over the course of this year. The other thing that helped to decrease prices over the course of the year was just the decrease of raw materials, things like busheling scrap, which is shown on the right-hand side. It's almost a mirror image of the price of steel. And that makes sense because 70 to 75% of the steel in the United States is made by electric arc furnaces, which are using scrap to make that steel. Now, worth noting over on the very far right-hand side, it hasn't been occurring for very long, but there is a very slight blip higher in the price of scrap. So could this be, as we start to roll into 2025, could this be a trend that continues as we roll into next year, which would then lead to a little bit of inflation in the price of steel? I think if I'm a betting man, I'd probably say we're going to see slightly higher prices in Q1 and Q2 versus where we are right now. Some of that's going to be due to seasonality. Some of that may be due to impeded scrap flows due to colder weather in the winter months. But between all of those factors coming together, it looks like we could actually see a little bit of a move higher and a beginning of a trend higher due to raw materials perking up a little bit.
Do you see, and not to give out numbers or anything, but are you seeing greater interest in companies, customers looking to lock in pricing right now?
Yeah, I mean, given the fact that given that we've been in contract season for the last couple of months, we've certainly been quoting and trading quite a bit of steel for 2025. There is a slight premium to do so, just given the shape of the futures curve. We've talked about that in prior months. There is an upward slope. So each month you go out into the future, there's a bit of inflation. But that being said, if price stability, price certainty is something that our customers have in mind, and then that's something that they desire, absolutely something we can do, and it is something we do quite a bit, not just in steel, but in aluminum and stainless as well.
What's copper as well? Okay. What are the tariffs? Obviously, are a concern on the mind of steel buyers as well, right? These days.
Yeah, it's interesting. I mean, even without renewed tariffs on other countries right now, I would say the import threat from a pricing standpoint really isn't there right now. Just given that U.S. prices right now are, let's say, they're high 600s. If you contemplate the possibility that, there's discounting involved, which I would say there still is discounting to the indices in the markets, you're talking about, physical steel prices for hot roll that are in the mid to low 600s. The numbers that we're seeing from foreign suppliers just aren't really all that competitive or attractive relative to those. So I don't think, tariffs or no tariffs, I don't think the import penetration is a massive risk, particularly in sheet products at the moment.
All right. So you predicted prices would go down. That was kind of a given, right? So let's give you a half on that one. So now you get 2 out of 3. Is that fair?
Oh, come on.
Oh, all right. Okay.
I think I deserve full credit on that one.
All right. Okay. All right. We got it. You have full credit. 2.5. All right. Hey, that's really good. Convergence. All right. This is more about product mix, right? So in 2024, pricing dynamics of steel sheets, tubes, and plates are expected to converge, reversing the divergence seen in recent years as end markets aligned. So there was a kind of a divergence, if I'm reading this right, the different products, right? So you're saying all those would have kind of came together more so in 2024.
Yeah, yeah, and I hate to call anybody out on this, but if you recall, what was it, a year ago, 2 years ago, that we talked to Nucor, their head of commercial?
You won't give that up, right? You won't give that up
Well,
that he called you out, right?
But the story was, at that point in time, we had plate prices at extremely high levels relative to hot roll prices. And if we take a look at this chart, if you go back to 2012 through COVID lockdowns, it tended to be the case. And I'm not going to do the math on it, but you can see it pretty easily with your eyes. There tended to be a fairly decent correlation between hot roll prices in pink, the price of tube, which is going to be in the blue, and then the price of plate, which is going to be shown in green. They generally moved in lockstep with one another. I think for the most part, that kind of makes sense because they're made from the same raw ingredients. They go into similar types of end markets. But what happened back in 2022, 2023, the price of plate just skyrocketed and stayed extremely elevated for a long time, much longer than I thought it would have. And yeah, I asked Mick Beamy from Nucor, I said, when is this going to correct? How can you explain that plate prices are so elevated relative to sheet prices? This makes no sense. And his response was, no, it does make sense. These are two different markets, two different end markets. The world of plate is much smaller, fewer players, and as such, it should go under its own pricing dynamics. And, he's right. He is correct. He obviously knows the steel world very, very well. But even with that, I still said, I think that this is going to converge at some point. And you did have the addition of, new production capacity coming online for plate, which is going to add additional pressure down on markets. So I fully acknowledge that there are some new factors that took place over the course of this year that maybe weren't fully in place when we spoke to him last time. But yeah, you're right. I'm not going to let this die. But but very much so. You can see that the price of plate, which is shown in green, has very much so converged back down closer to hot roll prices.
And I think that was about 2 years ago we spoke with.
I think it was. I think it might have been March of 2023. I think it was. So
yeah.
Again, he was for the most part right at that time, and it took a long time for it to converge. But I got him this time.
Yeah, there you go. Yeah, you waited him out long enough.
Yeah, and this is just a different visual way of showing the same thing. This is looking at hot roll prices relative to plate prices. There's a lot going on here, but ultimately, if you look down in the bottom left quadrant of this, that's showing the relationship of plate pricing relative to hot roll pricing. And you can see 2016 through 2020, it tended to be a fairly consistent spread of somewhere around $100 to $200. What's interesting is for a very, very short period of time in 2021, hot roll prices actually went upside down and became a premium product to plate. So the exact opposite actually happened for a short period of time. And then you can see the craziness that we were referring to, which is for about a year and a half, almost 2 years, the price of plate relative to hot roll was inching up, close to $1,000 a ton for a period of time. So just extremely, extremely elevated levels. But as you can see, that roller coaster ride is coming to an end for now, and it's all the way back down sub $200 at the moment.
Okay. Another win, another hit there for you.
I'm going to call that one a win. Yeah,
3.5 out of 4. Okay, yeah. All right. So we took a macro one, and this, for longtime listeners, this was a storyline for the longest time, right? Waiting out China's to come or not to come stimulus package following COVID, right? But they're a large consumer of metals, and will remain the driving force. The dominant force driving global prices, with strong demand in technology and infrastructure sectors balancing out the weakness in the property market. So I think the prediction here, or the projection here, right, is weakness in property, but the strong demand from tech and infrastructure coming out of China, right?
Yeah, it's kind of a complicated prediction, but yeah, that's how I would summarize it as well. That there would kind of be a divergence in end markets, and this one maybe I should ding myself a quarter of a point just for the prediction in of itself, because
quarter of a point,
just a quarter, just a quarter of a point, because if we were wound back to January of 2024, I would say this phenomenon was already taking place and had been taking place. So this was more of a suggestion or prediction that it was just going to continue taking place. And as you can see in these three charts, we've shown these in the past, but this is fixed asset investment into three different subcategories within the Chinese economy. Left-hand side is showing manufacturing, obviously 9.3% investment growth year over year. That's quite a strong number. So that's going to be things like automotive build-outs. That's going to be technological build-outs. You got the middle section, which is infrastructure. So that's going to be things like the electrical grid, maybe some energy infrastructure, things like that, growing at 4.3%. Not a bad number, not a stellar number, but a pretty okay number. But then over on the right-hand side, you've got the black eye of China, which is the fact that their fixed asset investment is down 10.3% year over year, which is it's similar to last year, but it's actually incrementally even worse on a percentage basis. And so you can see that these themes of strong manufacturing, strong infrastructure, and weak real estate, it's not necessarily new. The prediction was more that we were going to see it continue, and that was going to have an impact on metals markets. And you know where I would say we got this pretty right. And again, it was more of a continuation of the same theme, but this is looking at aluminum and copper prices in blue and orange relative to steel prices in China. And so the argument here is if you've got weak property and real estate sectors, that's going to weigh on things like steel rebar, steel sheet. It's going to weigh on cement prices because you're going to have fewer high rises and big buildings being built for people to live in. And I would say that has been the case. You can see for the last several years, there's just been every single year a bit more degradation in the price of Chinese steel. You know, could also make the argument they just have too much production, which is also weighing on prices. But there's no doubt about it. Their investment into the property sector is quite weak still to this day. I think that's going to improve in the coming year or years as they launch more stimulus. It does look like in the last week or so, they've taken a much more serious stance on trying to support the consumption and the end users. So I think that's eventually going to feed through to a stronger market, not just for the consumer, but also for commodities. But what's interesting is when you compare steel pricing to copper and aluminum, which I would argue is more heavily going to go into things like the electric grid and the production of electric vehicles and green energy, solar, wind farms, whatever it may be, those markets are much more supported. And I think that's what they're seeing in some categories and then the we've had property. So I'm going to call this one a win, Mike.
So,
but
okay.
but only 3/4 of a win.
Yeah. So if my math is correct, 4.25 out of 5.
We'll go 4.25 out of 5. Yep.
Wow, that's impressive. I mean, all kidding aside, as a hitter, you'd be just good enough for the Cubs that want to trade you because you'll be commanding too big of a salary. But you're, I mean, and all kidding aside, that these weren't softballs by any means. I mean, I think there's some good guidance going into the year, and you should tip your cap. I think it's a good one.
There's some good news and bad news in this. Being a risk manager, when you have a risk management hammer, everything looks like a nail. And unfortunately, in the year of 2024, I would make the argument that my job, this was a perfect year for a risk manager. You can be bearish and you can be right. And in many of these things, these were downward type predictions and we saw a lot of downward type moves. And I would say whether you're looking at China, whether you're looking at Europe, China's property sector, namely Europe, even parts of the United States, I would say we have seen some weakness in end markets over the course of this year. Volumes have been slightly down. Prices have certainly been down throughout most of the year. And so for a risk manager, it fits my mold, what I'm supposed to do as a risk manager for Ryerson. It fits it very, very well. That's not going to happen in every year. I can tell you, risk manager was not something who was I wasn't a hot commodity back in 2021 when steel prices were going to $2,000. Our salespeople were selling metal for large amounts of money, but a very different story. Yeah.
Yeah. No, still debating the one about you predicted steel prices are going to come down. I mean, that was kind of a given, but we'll take it. All right. Nice job. Nicely done.
All that being said, I'm not going to pat myself on the back. I'm not going to rest on my laurels. I got some things wrong. And so I'm today years old that I learned about the humble hedgehog. Apparently this is some like cartoon character that exists on the internet. I'm going to throw myself under the bus on a couple things that I got wrong this year.
Okay. I've never heard of humble hedgehog either.
I'm going to have to do a little bit more research on it because I just learned about it earlier this morning.
Is it like a game or a show, or is it like something you?
I think it's more
call
like an
somebody?
online cartoon, like
Oh,
comic.
okay.
Yeah.
Gotcha. Okay.
Yeah.
Check
They've
it
got
out.
hundreds of different characters, but I'm going to be humble hedgehog today.
Gotcha.
Because
Okay.
I don't get it all right. What we're looking at here, literally just 30 days ago, I made a prediction, and for now, I'm looking dead wrong on it. My prediction was based on the way the price of United States steel stock was performing post-elections. I made the prediction that I thought the odds of the acquisition from Nippon Steel to U.S. Steel was getting more and more likely to go through. For those who don't know the details, it's currently under CFIUS review. That CFIUS review basically is monitoring whether or not it's good for national security, essentially. And their ruling is expected to come, I believe it's on December 23rd. And so it's not until that point in time that Biden at this time can make a ruling on whether or not he's going to allow it or not. But that being said, about a week ago, Joe Biden hit the headlines and he said, I am definitively going to block this deal. And you can see just in the last couple of days, the stock price of U.S. Steel has dropped pretty substantially, and or month over month versus 30 days ago, the price of stock's now down 10%, which is just it's one way of reflecting the idea that the odds of this acquisition are going down very quickly. Is there still a possibility that something could happen? Absolutely, I would say there is. If the CFIUS review goes positively and they rule that it's allowed to go through, maybe Biden doesn't want to allow it to take place, but perhaps, the new administration allows it to go. Or maybe the structure of the deal maybe looks different. Maybe Nippon Steel buys certain assets and then somebody else buys other assets. I think there's going to be more to the story personally, but at least for now, I've gotten this one dead wrong in the last 30 days.
I'm not wrong. Didn't Trump come out and say he wouldn't be in favor of that either?
He has. Yeah, he has. Now, that being said, and while we're on the topic, he also did say about a week ago, via social media, he said, any company that makes an investment over $1 billion into the United States, he wants to essentially fast track the approval process, the permitting process, the ability to get things done. Whether it's a foreign entity or domestic entity, it's just a way to say we want to incentivize investment in this country. Sure. Now, I kind of step back and say, well, wait, wasn't Nippon making the promise that they were going to invest billions of dollars into the United States? That kind of goes in the face of what Trump has been tweeting. So maybe there's more to the story. Maybe Nippon can say, hey, we're going to invest $3 billion or $4 billion. And maybe that's the incentive that maybe gets him to come off his line.
And for those who got, you said CFIUS? Yeah,
it's CFIUS. It's I'm going to blank on the acronym, but it's the Center for Foreign Investment, and I'm going to stop there. But it's basically monitoring whether or not activity from a foreign entity is safe within the United States.
Okay. Yep. Wasn't familiar with that. Okay. Yep. So I went wrong.
I only put this chart in here for because it looks like a Christmas tree, and we're in the season, but. If we were to go back to and I didn't state this publicly, I don't think on any Cup of Joes, but if you told me the stock market was going to be up nearly 30% in the United States in the face of higher interest rates and 5.5% interest rates, I would have said I don't think that's possible. I would have said we'd be closer to the later stages of the economy doing well, and perhaps maybe we even start to see some sort of softness or something looks like a recession. So it's interesting that, in my opinion, we have seen and maybe even are slightly in what feels like a manufacturing recession. But even in the face of that, we still are seeing over there on the left-hand side of this chart, stock markets have performed so incredibly well this year. And I'm just going to go on record and say I didn't expect that. I would have gotten that wrong at the beginning of the year. Now, while we're on this chart, you can look at all the other asset classes and asset categories. The United States was absolutely the bright spot within the equities markets. Now, the one thing I would caveat that with is it's not all things going up. It's not all things hitting record highs. A lot of that is being carried by the Magnificent Seven, which is your very large market cap companies that are most heavily tied to technology. And as we've referenced in a lot of Cup of Joes, the services side of the economy is still going gangbusters. It's still quite strong. So that's been where a lot of the leadership within those markets has come from. Flipping over to the far right-hand side, looking at commodities, if you look at a broad-based index of commodities, they actually are slightly up. But as we talked about, many of the metals that we cover, whether it's, nickel prices or steel prices, many of the things we watch here on Cup of Joe are actually down year on year. So a lot of that's really being carried by, as you can see in the chart, precious metals. Price of gold's up massively, price of silver's up massively, and that's a bit of a surprise as well, particularly given the fact we had high interest rates. The other thing that I would say I got wrong from 30 days ago is I did mention the fact that cryptocurrencies were gaining a bit on the fact that Trump was in office, and allegedly Donald Trump's son, Barron, is a big into crypto guy. And we did make the reference that crypto prices were hitting record highs. Now, I kind of thought that was going to be it. It was going to be an election-related rally, and that was going to be all we saw. Well, lo and behold, as you look at this chart, since the elections, the price of Bitcoin is up 51%, which you can kind of see it up in the very, very top right of this chart, but it attempts to annualize that number. It's over 1,000% annualized. Asset classes typically don't move like that. There's a mania going on in cryptocurrencies. And again, this is not investment advice. I am not at all saying you should invest in this. Quite the contrary. I'm here to say I got this one wrong. I did not think that this was going to happen post elections, but it's been crazy. And maybe you'll have to edit this part out, but there's actually a crypto coin out there. I looked it up just before we hopped on here. It's the 212th largest cryptocurrency. It's called Fartcoin. And
Really?
Fartcoin now has a market cap of $500 million. So there's some crazy stuff going on in the crypto world. I'm not here to claim that I'm an expert in it. I am definitely here to admit and take my humble pie and say that I'm not generating the returns from those rallies. I am not involved.
Blown away.
Yeah, that's right.
Yeah. Well, what is going on with I mean, what's the, I mean, like you said, there could have been a little post-election bump there, but like what's continuing to put it on that upward trajectory?
Well, I guess if you were to ask a crypto fanatic or a crypto maximalist, I would say that their argument would probably be the United States continues to be a deficit spending nation, which should be destructive to a fiat currency like the US dollar, and should benefit things like gold and cryptocurrency, Bitcoin, which are allegedly finite. So those should be the beneficiary of a weak dollar policy and deficit spending. The other factor that's changed in the last 30 days is there has been speculation that the new administration is going to put in place a cryptocurrency reserve, literally almost like how we have the Strategic Petroleum Reserve, which is a reserve of oil and energy products to be there in the case of emergency, like a war or something like that. The argument from some is that the US government is going to put in place a cryptocurrency reserve, and they're actually going to load up on a bunch of cryptocurrencies, and they're just going to sit on it, and it's going to act as some sort of backing to the currency, almost like the gold standard back in the 70s. So those are the arguments. Whether or not those things are legitimate or make a ton of sense, that's for somebody else to debate. We are not a we're not a cryptocurrency podcast.
Gotcha. Interesting. Yeah. Just for the record, Scott, one of our listeners, has confirmed CFIUS is the Committee on Foreign Investment in the United States.
I got it.
Thank you, Scott. Yeah, very close.
Scott. Appreciate it. And last but not least, so I'm not advocating for sports betting, but I will admit that beginning of the season, actually not even at the beginning of the season, all the way back in January of 2024, that is my betting slip. I made a very small bet on Ohio State to win the national championship. I thought they had all the pieces there to do it. And even after the loss to Oregon, I was still feeling pretty okay because it was a 1-point loss. We come into the last game of the season against Michigan, our arch rival. We're 23-point favorites, and we looked like garbage. And so I don't have a whole lot more confidence in this. So I'm just, even though we're in the playoffs, I don't have a whole lot of confidence right now after that game that we've got the coaching staff or the aggression to win these games we have coming up. We've got a tough road ahead because I think we probably have the toughest route to get to the championship game. But man, that stank. And congratulations to anybody in the Michigan area or who's a Michigan fan. The bet on the right is not looking all that great right now.
Things got a little testy at the end of that game too. Planting the flag there. Yeah.
Yeah, sure did.
Yeah. So, yeah.
All right. We're going to bury that one. We're never going to discuss that ever again.
Well,
And I hate
hopefully-
to say that I noticed the number of questions actually went up while I was presenting on the slide. So that doesn't make me feel real good.
No. Well, good. Well, eating some humble pie there.
That's right. I've got a couple things on the macro side that I want to touch on, but while we're on these macro slides, I want to touch on looking forward to the next 2 months from now. So Mike had mentioned that in the month of January, we've got a couple pieces to our Made in Mexico package. And then coming back in February, you're going to be getting a lot deeper dive into the macroeconomic factors that are driving metals markets, manufacturing markets. You're also going to get a lot more predictions from myself and forecasts for the next year, which hopefully 12 months from now, we can come back and review if those did any better or worse than 2024. It's going to be hard to beat. It's going to be hard to beat this year. But yeah, just wanted to tease that out there that'll be in the beginning of February for those next predictions.
Yeah.
With that said, I was on a podcast with a hedge fund manager, an asset manager called Double Line, and they've got a manager by the name of Jeffrey Goonlock, and he always does a fun way of breaking down markets and things like that. And in his opinion, he was kind of saying there are two different ways you can look at inflation, and in his opinion, you've got the left chart, which he believes is how economists and maybe even politicians look at inflation, which is you look at it on an annualized basis. If you look at it, the left-hand chart, what do you see? You see a big spike up in the last couple of years, but now you've seen this reversion of it coming back down into something that looks more like a normalized range. So almost like a success story for the Fed, that they've achieved their goal and we're back down into a normal range. So that may be how an economist looks at that and says, it's time to ring the bell. We've made it through inflation. Now, in his opinion, and I tend to agree with it, there's what he kind of believes the consumer, maybe your everyday man or woman within the United States, how they may look at inflation on the right-hand side, which is look at it on an index basis, go all the way back and index it to 1984. You draw on this trend line. You can see that for the better part of about 40 years, we've been on a fairly consistent, steady journey of inflation where, yeah, over time prices go up, but the good news is your incomes also go up, your home prices go up. Hopefully the stock market continues to perform well, and you can combat that inflation with other means of income and wealth. What's fascinating over the last couple of years is even though the left-hand chart kind of looks like a success story for the Fed, the right-hand chart kind of says we've very much so deviated on an inflation standpoint from this trend line, and we have come nowhere close to getting it back on that trend line. If you just kind of draw out that line and forecast it forward a few years, it looks like it's not going to be for years and years that inflation trend line is going to get back to where it's been over the last 40 years. So I just thought this is an interesting way to depict the story of, this could be one of the explanations as to why many in America say costs are still too high. We're struggling to pay for things, even though maybe DC and the Fed is kind of ringing the bell and saying we've hit our inflation targets.
So what are the pink lines indicating?
Yeah, so the pink lines are going to be historical recessions.
Historical recessions. Okay.
Yeah.
So we kind of have a thin line there, 2020, nothing official, right? Because it's not an official recession, right? The 2022. Okay.
Yeah, they did technically declare one for a very short period of time during the COVID lockdowns. And I think rightfully so. It was markets were in a pretty bad spot, and some of that was mandated, but yeah, that was the last one that we've seen, but it was very, very short-lived. So yeah, I thought this is a very interesting way of looking at the inflationary picture, particularly in the light of elections and what people seem to have issues with over the last couple of years.
Yeah. So if I read this right, it's consumers, yes, acknowledging prices are going up, but it's fine because income's coming up and it can kind of handle it, right? But
until recent years where we've actually seen costs go up at a more exorbitant pace.
Makes sense. Yeah, that's an interesting way to look at it. And I would think that would be pretty accurate. Particularly how economists look at inflation for sure.
Yeah, definitely.
Good stuff. And this is Double Line? Yeah,
Double Line is the asset management firm that does these. I think they do maybe like once a quarter, they'll do a podcast. Try and keep an eye open for it.
Nice.
Yeah, you can visit their website and find the next
good stuff.
But with that said, even though inflation is close to the Fed's goals, and even though inflation is still well above the consumer's goals, as that last page showed, there's still 98% odds, as you can see up in the top middle of this page, 98% odds the Fed is actually going to continue cutting at their next meeting next week. So I find that very interesting that we still have inflation running above trend. You still have people feeling the pain from inflation, and yet the Fed is cutting interest rates, which actually is a supportive thing for prices. So what in the world are they thinking? What in the world could they possibly be looking at? I think we made reference to this last month, but in my opinion, the Fed is looking at the employment picture and it is outweighing the importance for now of the inflationary side of things. I didn't mention this 2 slides ago, but we did just this morning get producer price index numbers, which is kind of wholesale inflation. And it was a bit spooky because expectations were for a month over month increase of 0.2%. The actual numbers came in at 0.4%. So literally a doubling of where expectations were. I would have thought that this percentage of cut, the market's expectation the Fed was going to cut, I would have expected that number to come down in the face of that higher than expected PPI number. Didn't budge. The odds are basically locked in that the Fed is going to cut no matter what. And why is that? I believe it's because they're very much so keenly watching the employment side of things. You can see it, you look back over time, we've touched on this chart quite a bit. The unemployment rate and its momentum, either to the upside or downside, tends to have very strong implications to whether or not we're heading into a recession or not. I drew in this pink line, which is the 12-month moving average. We have now ticked above that. You can look back at various points in time over history and see that oftentimes when the momentum ticks above that 12-month moving average, it tends not to stop until or unless it hits one of those red brick walls, which is an official recession. So, this may be something that Trump and the new administration is going to have to deal with, that R word. But I think this is definitely why the Fed is still acting to try and bring rates back down to a normalized range.
Do you think there's some that are saying that recession is never good, but like it's almost needed in some case to break this?
It's possible. Yeah. I mean, it is certainly possible. I mean, this is where you come down to the proverbial soft landing, hard landing, no landing. Yeah. I think the goal is to cause a little bit of pain, but hopefully not too much pain. I was talking to this customer just before I hopped on here, and I brought up the idea that, and I don't want to get too deep into politics, but even this notion of like the Doge group, which is Elon and Vivek, where they're hoping to go into DC and make it much more efficient and maybe cut spending, which may result in cutting jobs. That's another thing I think we want to keep an eye on because, again, not talking politics too much, but if they are successful in doing what they say they want to do, which is cutting excess spending, cutting excess jobs, that could actually feed into a higher unemployment rate, which would actually be a disservice for that administration because it would speed up the rate at which job losses are occurring. So I think that's going to be an interesting thing to watch here in the coming months as well.
Yeah, definitely. Okay.
Now, that being said, even though we may be seeing the broad employment picture getting a little softer, there's some things in the manufacturing world that are actually getting a little better. And I don't want to call a victory yet or call a turning point quite yet, because we want to see more of these data points as we roll through the next few months. But as we look at the global PMIs, and I've highlighted the main areas and main regions we watch, which is China, the global figure, US, Canada, Mexico, and then Europe. You look at the July through October timeframe, and that was some pretty weak data. It didn't feel good at all. Volumes were decreasing out to end users. Prices continued to come down, and that's really the area where I would say that's what led me to believe we kind of did have a bit of or maybe still are having a bit of a manufacturing recession where volumes a bit squishy. The manufacturing PMIs are all ticking sub 50, which is year over year declines. But what's interesting is in the last 2 months, we've begun to see some of these major regions turn a little higher. Not Europe. Europe is still a disaster zone, but the Canadian numbers ticking up to 52. China's numbers ticking up to 51.5. Even the global number is now back to flat. There's a possibility that we've already seen the damage on the manufacturing side of things, and we're already beginning to emerge out of it, which, that's a bit optimistic. That's a bit hopeful. But I think, you include that with the fact that seasonally wise, January, February, March tends to be a pretty good time for manufacturing conditions and market demand. So, 1 month or 2 months doesn't quite yet make a trend, but there's a chance that we could be seeing a little bit of optimism. I think some of that, again, not to talk too much politics, but it seems like there's been a lot of investment that was sitting on its hands waiting for any result, any type of clarity, whether it was Harris or Trump. I think people were waiting just to see some sort of clarity, and some of that could feed into more investment here domestically. Interestingly, the the Conference Board leading economic indicator, which is a compilation of about 10 different indicators, it's kind of corroborating that PMI data, which is the worst may be behind us in terms of the declines. And even though we're still in negative territory, both the 12-month and the 6-month annualized figures are sitting right around -4%. You can decisively see that the trend is heading back towards something that's flattish, or maybe even it gets into positive territory. It does kind of sync up with those PMI numbers we're seeing. And if we include the fact that China's seems to be taking a more hard stance on stimulating their economy, using language that they haven't used since like 2011, there's a chance that provides a bit of a rising tide lifts all boats phenomenon as well. So with that, that's I gave you a little bit of a sneak peek into some of the potential things we roll into 2025. I think there are some factors that we should be watching that should give us a bit of optimism for the manufacturing markets. I look forward to getting into our predictions for 2025, and hopefully we get anywhere near the type of success we had in 2024.
Yeah. Well, you throw in the ones that you threw yourself under the bus, right? Was that 4 of them?
I think we had 4 that I threw myself on, and I got plenty more wrong than
brought
that.
down your average.
Yeah, you can just ask my wife; she'll tell you.
Truth be told, I mean, this is it's a hard thing, right, to predict, and these past few years have been anything but normal. But I mean, I think the data shows that. I mean, there's going into 2025. I mean, I think like you said, pardon me, a lot of folks, now that there's clarity in what's going on in Washington, and could provide a little bit more guidance, whatever side of the aisle you're on. It certainly should be pretty interesting. And I mentioned earlier, I was talking to some of our supply chain directors. I do a kind of a year-end analysis that we put out in our monthly market report, and all 3, aluminum, stainless, and carbon, mentioned, the biggest thing on they're getting asked by customers is the tariffs, and what's the likelihood it's going to happen, and what's the impact, and that's where the aluminum one really stood out to me, right? Because I had no clue how much was being produced in Canada, and it struck me like how hard that would rise up the Midwest premium cost. But it makes sense, and like you said, some say yes, but you would talk to a few that said there's probably a good indication. Who knows until January.
Yeah, I mean, it's an interesting thing. And again, I don't want to spend too much time in the political realm and predicting, the mind of Donald Trump. But in some ways, fortunately or unfortunately, we have to talk a little bit of politics, because it does impact metal prices. And as you mentioned, in the case of aluminum, a 25% tariff on Canada wouldn't just be a slight increase. It would increase the premiums alone from about 20 cents to close to 50 cents. So that's meaningful. And not to give a plug to myself and what I do, we do have the ability to hedge Midwest premiums and Midwest aluminum ingot. So if that's ever of interest, we can certainly have that discussion. Now, I personally, as I've been talking with colleagues, I personally have a relatively low probability in my head of the Canadian tariffs, particularly for aluminum, because its potential impact on inflation. It would be meaningful, it would be quick, and for that reason, I don't think it's going to be taken. But what's interesting to watch is whether it's Canada or Mexico, already, and I would say this has been happening for the last several weeks. There have been a lot of administrators in both Mexico and Canada who are already coming to the table and seemingly not waving the white flag exactly, but definitely suggesting that they're willing to talk and willing to negotiate and wanting to negotiate. And again, I'm not in the mind of Donald Trump, but I think that's the point. I think the point is we're going to put a bazooka out there as a threat, and then you're going to come to the table and you're going to make certain promises. And if you make those promises, we'll pull the bazooka back. And I like to hope and think that that's how this is going to go. I had CNBC on yesterday afternoon, and one of the head government officials for Ontario was basically on CNBC, almost begging and pleading to negotiate and talk to us and work with us, and was effectively bragging about how much business they do and want to do with the United States, and those things. That's how negotiations work, and I think those things can be good for both sides, and I hope they are good for both sides. Unfortunately, tied up in all that rhetoric is going to be a lot of social media posts that are going to be agitating and frustrating and all that. But there is method to the madness in some capacity, it seems.
Yeah, well said. Well said. And it's a nice little precursor to, again, in January, our Made in Mexico series. One of the gentlemen we spoke to talks about kind of navigating customs, and we talk a little bit of tariff in there. And I think we did those interviews like, was it a week before or after the election, right? So we didn't get too much into the effects there, but I think the idea is how to navigate that. And if you're moving production out to into Mexico. So I think it'll be a fascinating discussion. And so even though we're going to be gone for a month, we gave you a few episodes there to kind of fill the void, if you will. And I just want to take a moment to say, Nick, every time we do this, I get a little much smarter on the metals world. So I appreciate these times all the time. And I know our audience does as well. I want to wish everyone a happy holidays. Spend a great time with your family and friends, and keep in contact with your Ryerson sales rep for how things are shaking out. But as always, want to give you the last word, Harry.
I don't have much to add to that. I'm thankful for you, Mike. I'm thankful that you and the marketing team, Jason, and everybody, put together this podcast nearly 3 years ago.
Yeah, it's going strong.
Still going strong, but
yeah,
having so much fun with it, and we hope our customers are enjoying it and getting something out of it. And as always, as we head into 2025, if you've got ideas, you've got topics you want us to discuss, we absolutely want to. But in the meantime, have a great and healthy and safe holiday season, and we look forward to celebrating more and learning more in 2025.